So the S&P 500 equally weighted index just hit new all-time highs, and of course Wall Street is celebrating like it's time for bottomless mimosas at brunch. And of course, why wouldn't Wall Street want to celebrate when everything is pretty much pushing upwards? So recently in my free weekly market post insight, I shared how since 1930 there have been 23 elections, and in 9 cases, stocks rose that day after. However, more importantly, in every single case, the S&P 500 was higher 10 days later, and then 3 months later, it was up 7 of those instances, which is 30% of the time. And of course, that's pretty bullish and interesting from a historical perspective. But for those of you guys that don't have access to the free weekly market post insights, make sure to check out the links in the description below, because one of the links is going to give you access to sign up, where every single week I send out a free weekly market post insight so you can see what's taking place in the markets. And of course, why would you not join? It's completely free. But now, taking a look at where things currently are, when we take a look at the volatility index, what we see is that volatility is pretty low, kind of similar to what we saw back in August. And if we take a look into the S&P 500 equally weighted, we saw that was a pretty good bullish period for the markets. And so with volatility at these low levels, we may end up seeing this momentum continue just like what we saw in August. But of course, historical price action isn't indicative of what we're going to go ahead and see moving forward, but just something interesting I wanted to point out. Now, in terms of where we are on the fear and greed index, we are on the higher end of greed, which of course isn't bad. This doesn't mean like, oh my gosh, things are greedy, you have to sell out of your positions. Of course, no, right? You should always, first of all, do whatever you see value in, but just a friendly reminder that when we're kind of around these high periods of greed, it may just be a good opportunity to kind of lock in some profits, trim a little in some areas where you have a lot of exposure. For example, if you have a lot of exposure in a particular stock or a particular sector, this may be a good opportunity for you to kind of trim on those positions and kind of rotate to a more balanced portfolio. This way you're not overly exposed to just one area. But again, you should only trade and invest in whatever you see value. Now, one of the areas that I see value in that I shared within the Push and Profit private group was the small cap sector. Now, of course, we're just looking at the charts, so we see things from a technical perspective. We see we broke out of this ascending triangle, which is pretty bullish. But one of the things I shared for those within the Push and Profit private group just a few days ago was how small caps tend to benefit from a growing economy and interest rate cuts. And so with this Trump administration promising to be more lenient towards corporate regulations, this could lead to more mergers and acquisition, which is pretty bullish for a lot of the small caps, simply because it could save time and money on legal compliance processes. And so we're kind of in this favorable environment for small caps. And then on a technical level, we saw the ascending triangle. Things are looking pretty good for the small caps, and I think the small cap rally is likely to continue extending. But of course, we have to talk about a couple of other things taking place in the broader markets, and that is where we are from a fundamental perspective. See, for the S&P 500 Q3 of 2024, 91% of the companies reported earnings, and 75% of the S&P 500 that reported earnings had a positive earnings per share surprise, and 60% of the companies reported positive revenue surprises. And so from a fundamental perspective, yes, things are pretty rich, things are pretty overly extended right now, as there's a lot of this hype into the stock market right now with, what potential, policies could take place with the Trump administration. But the good news is there's somewhat of this backing of what we're seeing from a fundamental perspective. Now, yes, can we be slightly a little bit more frothy with the prices than what the fundamentals are? Yeah, but the good news is at the backdrop of things, fundamentally, the markets are pretty strong. And that's something that you want to see in correlation. It would be one thing if it was just a lot of hype that was really backed by a lot of nothingness and a lot of nonsense. But we have this hype taking place at the same time when the fundamentals are looking pretty robust. Now, this week is a pretty data dependent week for the stock market, and I highlighted some dates that you may want to just pause the video and kind of just look at, because we have the CPI report coming out this week, which is an inflationary gauge. I believe CPI may actually come a little bit higher for this report, but I don't think it's going to be of anything of much substance. I think it's just going to be because we're kind of cutting off the previous periods, which kind of changes the averages. But of course, we also have Jerome Powell speaking, and we kind of want to hear a little bit more of the insights of what we're hearing from the Federal Reserve. But on top of that, we get initial jobless claims and then retail sales. And the reason why retail sales and jobless claims are important to watch is because, yeah, fundamentally companies are looking good, but we want to see where we stand from a macroeconomic perspective, because of course we want to see the economy still kind of teetering on this good trend of things are looking pretty well. Because of course, if the economy can continue to hold itself with, people not losing their jobs and the economy still growing, well, that would be favorable for the stock market, because the macroeconomic climate impacts what the fundamentals of companies are. And I think a lot of people tend to forget that the economy impacts businesses and businesses impact how your stocks perform, right? Because if we're in a bad economy, right? A bad economy is, and I think this the worst, is when there's a lot of job losses, right? If you have everyone losing their jobs, companies are firing, well, that's not good, because then people are not getting their paychecks. And if there's no paychecks coming into your bank accounts with, your checks or direct deposit, whatever it is, then you're not going to be spending on these other companies. Now, yes, companies are still going to be spending, especially I think in this AI kind of environment. Companies are still going to go ahead and pour into AI, but we still want to see the overall, because we have to understand GDP is made up basically or mostly on what the consumers are doing. And of course, if people don't have money to spend, well, that would be really bad for the fundamentals, right? That would be really bad for a lot of these businesses, which of course would crush stocks. And so what we're looking for this week is trying to see, are we still on a positive trend on the macro outlooks? And if we are, then that could sustain this bullish momentum. If we aren't, and we kind of see some pain points kind of come in and roll out with this week's data, well, then the hype that we just got within the last few days may kind of start to fizzle out. Now, I want to go ahead and kind of just talk about things from a technical perspective as well, just kind of hop into my charts. But before we do so, just a friendly reminder that if you have not done so already, make sure to tap that subscribe button, as it does help out with the channel. And with that said, let's go ahead and hop into my laptop. Alrighty, so we are officially in my laptop, and I wanted to just point out something pretty interesting that I think we should all be aware of. And that's the fact that yes, we did see the S&P 500, the weighted version, right? This isn't the equally weighted. Equally weighted would be RSP, right? But the weighted version of the S&P 500 did indeed hit new all-time highs today, right? So that's good news. But one thing that we want to be mindful of is that when we take a look at the largest weightings within the S&P 500, right, those mega cap names, we see that Apple had a red day. We also see Amazon had a red day. We also see that Nvidia had a little bit of a red day, and then we also see that Microsoft had a little bit of a red day. Let's also take a look at Meta. I'm not sure if I mentioned Meta or took a look at Meta. Yep, Meta had a red day. So what we see is like the S&P 500 reaching new all-time highs, and that's good. But those companies that have this major weighting, right, like Apple, Amazon, Microsoft, Meta, etc., right, they're declining. And so what does that kind of suggest? Well, that suggests that there's kind of this rotation taking place in the market. And so this scenario indicates that, sectors or stocks with smaller weightings in the index are outperforming and offsetting the declines in these heavyweight stocks. And that kind of leads back to what I mentioned within the Push and Profit private group, mentioning how I think the smaller companies are going to start to see more of this kind of capital inflow take place. And so this, internal rotation, it could be a healthy sign of course, reflecting a broadening of market participation beyond the dominant tech sector. And so that's good. And, we may continue to see market participants reallocating capital into into those, undervalued or previously underperforming sectors, kind of seeking that diversification and, potential growth opportunities. However, it's still something that we're going to want to monitor closely, because if we have this trend, right, of the leading, stocks continuing to decline while the index rises, it could also signal underlying weakness masked by gains in less influential sectors. And so we kind of want to be mindful of that, right? That's something that we're going to continue to watch. Of course, we're going to continue to see the data enroll for this week. Like we said, we have CPI, we also have PPI, producer price index, and then we also have the retail sales, Jerome Powell. That's something we're going to want to watch for this week. But of course, in addition to that, we want to see what the mega cap stocks are doing, because this sustained divergence from, the performance of the major constituents and the overall index could also warrant kind of this unhealthy market and, the sustainability of new highs taking place kind of weakening. And so hopefully didn't delve too deep into things. Hopefully that makes sense. Just kind of wanted to point that out there, right? Now, of course, we did see Palantir, right, continue to go up, made new highs today. We did see Tesla make new highs. So, we're seeing, tech names still. Oh, that's not Tesla. Oh my goodness. TSLA. Sorry about that. Tesla, still pushed up. Oh my goodness, it's crazy. But we did see tech names still push up. I'm not saying tech is dead. I'm just saying the large weighted, companies, they're kind of having a little bit of a red action take place over here, and we want to just kind of monitor that. But hopefully you guys got some value in today's briefing. Make sure to subscribe, check out the links for that free weekly market post insight, and I'll see you guys on this next video right over here. Take care, guys.